Hey everyone, Professor Stefan here. Today we are starting our second lecture on accounts receivable. And in this video, we're going to talk about one of the ways that we can kind of get cash faster without waiting for our receivables to be collected. So let's get started. So this topic is going to be all about transferring receivables. So what is a transfer of receivables? It is basically either selling your receivables to somebody else so you get some cash today, or using those receivables as a pledge, as collateral to borrow money today. And so why might a firm be interested in this? Well, some firms don't really want to be in the business of collecting on receivables, right? Their business might be selling some sort of inventory or providing some sort of services, and collecting on their receivables is just not where their expertise lies. Alternatively, they may be a little bit cash strapped, especially early young firms, right? Maintaining cash on hand is difficult. And so it might be better for them to collect cash today by selling their receivables or borrowing some money against them in order to kind of keep expanding, keep buying inventory, keep operating. And so they can get cash today instead of waiting to collect all those receivables. There is always a cost, however, and so we're going to see that with all of these options, the firm usually ends up paying some small fee in order to collect this cash sooner. So we're going to see three ways that a firm can transfer their receivables. They could borrow against them, using those receivables as collateral. They could sell those receivables, another word for that being factoring the receivables, or they could securitize the receivables. And securitizing them is basically turning them into something that could be traded on an open market. And so that's when a bank would take, a whole bunch of mortgages and bundle them together and sell those receivables to somebody that wants a nice steady cash flow like a pension fund. So we're going to spend the least time on securitizing receivables, but in this video, we will talk about the secured borrowing option. And then in class, we are going to cover kind of the selling or factoring option. So secured borrowing is essentially taking out a loan from a bank or another lender and using those receivables as collateral for that loan. So if you have $100,000 in receivables, the bank might say, hey, I'll give you $90,000 today, and you pay me back that $90,000 as you kind of collect those receivables as they come in. Now, the benefit to the bank is that they're going to collect interest on that loan, and there may be some kind of service charges with originating this loan. The key features here are that the receivables remain on the balance sheet of the firm. So the firm is going to continue to collect those receivables just like they always would, but now they have borrowed some cash so that their cash balance goes up kind of in the short term. And as those receivables come in, they start to pay down that loan. Now, like I mentioned, there are going to be costs associated with this. There are interest costs, like any other loan, and then there are service fees that are charged up front for this type of loan. And these sorts of transactions, this kind of collateralized receivable, would get disclosed in the footnotes so that investors or other lenders would know that, hey, this asset kind of has a claim against it. If this company stops paying back this loan, then the bank can come in and claim the collections from those receivables. Now, our journal entry for this type of transaction is relatively simple. We are going to debit our cash for whatever our proceeds are from the loan. We are going to debit whatever the finance charge is for this loan. So there could be some percent that I'm borrowing gets charged up front by the bank. And then we'll credit the liability or whatever amount we are expected to pay back. Interest charges then are going to come on the loan just like any other loan, where if we've held it for a month or 3 months or 12 months, when we get to our end of our reporting period, we will debit our interest expense. And if we need to, either credit cash or credit an interest payable account. So let's look at a simple example here. On January 1st, Hopper Company pledges $80,000 of receivables as collateral for a $60,000 loan from Rosie. So Rosie is loaning $60,000 to Hopper, and these receivables will be kind of that collateral for the loan. And so if Hopper does not pay this loan back, Rosie can come in and collect these receivables. Now, Rosie is going to charge a 1% finance fee on this loan, and that'll get deducted from the proceeds up front. And you also can notice that the amount that Hopper is able to borrow is substantially less than that kind of net fair value of the receivables. So usually the loan amount will not be for kind of the full value of the receivables, but those full receivables are pledged as the collateral. So if we take a look at the journal entry here, we know that Hopper owes $60,000 in liabilities, right? So we'll credit our note payable for $60,000. Now our cash balance, it sounds like we're borrowing $60,000 in cash, but we have to pay 1% of that loan up front as a finance charge. And so Rosie deducts that 1% before handing over the cash. So we're only actually collecting $59,400 in cash. And that $600 or 1% finance charge gets debited to an expense up front. And then over time, Hopper will kind of charge an interest expense and pay an interest rate depending on the remaining contract terms of this loan. So closing thoughts here. There are 3 different ways to transfer our receivables and kind of get cash more quickly. So secured borrowing is kind of the simplest example of this, where we effectively just borrow money from a bank and we use the receivables as collateral, with the key feature being that we maintain the receivables on our balance sheet. We collect on those receivables and we use the proceeds from those receivables to pay off that loan. So we'll talk about the sale of receivables, which gets a little bit more complicated in class. And then we'll just briefly mention kind of a little bit more the securitization of receivables. So thanks for watching.